Hi everyone, Emma Davidson here of the Global Value Fund. As you may have seen, the company has just released its full year accounts. Now, these can make for pretty dense reading, and so this year I thought I'd hit the highlights of the annual report in this short video. Top of the pops, GVF had a terrific year. Shareholder total returns were up 32% off the back of portfolio returns up around 30%. And this incredible performance has driven a large increase in dividends. The company has increased the final dividend by 14% to a 3.3 cent fully franked for the half. And the board has guided that it expects to maintain this level of dividends. So that's 6.6 cents a year for FY2022, which would gross up to 9.4 cents if the dividends were to be fully franked. GVF's grossed up yield sits at around 7 to 8%. And that's a 7 to 8% yield from a lower risk portfolio than a traditional basket of shares. Another comment I'd make is around the sustainability of this newly increased dividend. On page 37 of the annual report, the profits reserve sits at almost $35 million. And this means that even if the company were to make no more profits from here on in, it would still be able to pay the 6.6 cent dividend to shareholders well into 2025. Also in the annual report, and a date for all of our calendars, is the GVF AGM being held virtually this year on the 11th of November 2021 at 16:30 AEDT. Sadly, and contrary to Miles and my update in May, we've had to postpone our trip to Australia again, and we'll now be trying to visit everybody in March 2022. Another highlight for me in the annual report has to be Miles's letter to investors. As usual, his letter is detailed and articulate, and it runs through a couple of key themes that I'd highlight as follows. Reaching for normalcy. Miles talks about a natural need for us as humans to dwell on the past 18 months, given how extraordinary they've been. He reminds us, though, that markets have moved on. They've moved on to far more anodyne concerns, which offers us all some wonderful hope that normalcy is sitting just that little bit further along the horizon. From there, Miles looks at the performance of the investment portfolio for FY2021. The key takeaway for me is the fact that 80% of the portfolio returns came from the discount capture part of the GVF strategy. Not only did the discount capture strategy shine, but it once again highlighted that GVF's returns were not the result of having ridden the coattails of enormous levels of government and central bank support, but rather it was a real value add. In the annual report, Miles shares this graph highlighting the actual dollar amount made by every single investment in FY2021. On the far left, the best performer of the portfolio added 3.6% to total portfolio returns, while the worst performer on the far right detracted just 0.15% from returns. For me, this heavily skewed distribution of winners on the left versus losers on the right is a very comforting picture to look at when thinking about our savings being invested. Also in the letter is an appendix of case studies from the year. I know many of you love these, and this year Miles and the team have given us 5 examples which all make for great reading. Miles's letter concludes with a glimpse into his thoughts on the outlook. He reminds us that global equity markets have delivered an average total return of 7.5% per annum since 1987. And he says that the last 5 years where global equity markets were up an average of 15% per annum is part of a spectacular period of price appreciation across the board, which has mainly been due to the relentless fall in interest rates globally. 2 observations from me. Don't fight the Fed. And is it really plausible that global share markets can continue to compound at 15% per annum in perpetuity? The answer has to be no. There would be few seasoned investors who would use long-run share market return forecasts of more than 8% per annum. My takeaway here would be that if interest rates do remain at today's incredibly low levels and barring some new unforeseen market crisis, expecting single-digit returns for most asset classes would seem to be the neutral place to sit. Against this backdrop, we would expect GVF to perform very well. The opportunity set continues to remain elevated compared to normal market conditions. And to be honest, even in normal market environments, the team have been able to demonstrate large amounts of outperformance over a long period of time through a range of different market conditions. I might end off with a quote from Miles, and it goes as follows. Finally, and most importantly, we remain deeply respectful of the fact that investors have trusted us with their hard-earned savings. All of which is to say that we will continue to run with our lower risk portfolio, focusing on unlocking value and generating outperformance, regardless of how the coming year decides to unfold. I could not have said it better myself. That's a wrap.